All right, welcome everyone. Today we're diving into something that's, well, it's more than just accounting. We're really going to be decoding the DNA of business itself. We're going to pull back the curtain on these hidden rules that, honestly, bring order to what could be financial chaos. And look, this isn't just about crunching numbers. Not at all. It's about becoming fluent in the grammar of commerce. And that's a skill that's going to serve you no matter what industry you end up in.
So let's start with a big question. Really think about this for a second. Every single day, trillions of dollars, euros, yen, you name it, are moving around the globe. What's the system that stops this from just becoming a complete chaotic mess of data? How are you, as a future manager or an investor or maybe an entrepreneur, supposed to make a smart decision when you're just looking at a sea of numbers? That's the core problem we're going to tackle.
Well, the answer is actually pretty simple and kind of elegant. It's a shared language. Think of it like a universal Rosetta Stone for business. It's what allows a tiny startup in a garage and a massive Fortune 500 company to speak the exact same financial dialect. And that language, the one you're here to master, is accounting.
Okay, so here's our roadmap. First, we're going to establish why we even call accounting the language of business. Then, we'll get into two of its most fundamental rules, the rule of measurement and the rule of boundaries. After that, we'll see these rules in action with a real-world decision-making scenario. And finally, we'll wrap it all up by talking about why this stuff is so crucial for your future success.
Okay, part one, the language of business and why rules matter. Before we get into the nitty-gritty, we have to understand the why. Why are these rules we're about to discuss the absolute, non-negotiable bedrock of the entire business world?
Let's stick with that language analogy. You can't just throw a bunch of words together and expect people to understand you, right? You need grammar, you need structure, nouns, verbs. It's the same thing with accounting. These core assumptions, these are the grammar. They're what turn a jumbled mess of financial data into a story that you can actually read and understand. Without them, it's all just noise. So, let's get to our first big rule of grammar. This is the rule of measurement, and we call it the monetary unit assumption. This all comes down to a really basic question. How do we measure everything in a way that everyone can agree on?
So what does this mean? Well, the monetary unit assumption is really just a formal way of saying that we have to use a common yardstick for everything, and that yardstick is money, in our case, the US dollar. And here's the key part. For the purposes of recording transactions, we assume that the value of that dollar is stable over time.
Now, this is where it gets really interesting, and it's a point of confusion for a lot of students. We ignore inflation at the moment we record a transaction. Now, I know what you're thinking. Wait a minute, that's not realistic. A dollar in 2025 is not worth the same as a dollar in 2026. And you're 100% correct. But here's why we do it. It creates a stable, consistent basis for our records. It simplifies things. Now, of course, in extreme cases, like in a country with hyperinflation, this assumption completely breaks down, and accountants have to use special techniques. But for most stable economies, this works.
So what's the payoff for making this simplifying assumption? It's all about comparison. If we didn't do this, trying to compare a company's sales from one year to the next would be a nightmare. It'd be like trying to measure a table with a ruler that's constantly stretching and shrinking. This assumption gives us a fixed point of reference. It lets us compare apples to apples, year after year.
Okay, so we have our stable ruler. Now we need to figure out exactly what it is we're measuring. And that brings us to our second huge rule, the rule of boundaries, or what we call the economic entity assumption. It's all about drawing a clear line in the sand.
And folks, this one is a big deal. The economic entity assumption means that the business is its own legal and financial person. It's separate from its owners. It has its own bank account, its own assets, its own debts. It is not just an extension of the owner's personal wallet. It stands alone.
Now please listen carefully to this, because this is probably the single biggest mistake new entrepreneurs make. You cannot, and I'll say it again, you cannot mix personal and business finances. That means the company's checking account is not for your personal groceries. The business credit card is not for your family vacation. There is a firewall between your money and the company's money. If you break that wall, you could be held personally liable for the company's debts. It is that serious.
And just look at the difference it makes. When you follow the rule, you get a clear, accurate picture of how your business is actually doing. But when you don't, you get a distorted, misleading mess. It's like looking in a funhouse mirror. You're not just breaking a rule, you're lying to yourself about the health of your company. And that is a recipe for absolute disaster.
So you want to see how this actually plays out? Let's walk through a quick scenario. This is a classic example of how violating just one of these basic rules can start a domino effect that ends in a really, really bad business decision.
Okay, so picture this. Step 1.
An owner decides to pay for a personal vacation using the company credit card. Step 2. The bookkeeper records it under travel expense. Now the data is corrupted, right? It's artificially inflated. Step 3. A well-meaning manager looks at the financial reports, sees the travel costs are through the roof, and decides to slash the entire travel budget to save money. Step 4. Now the sales team can't travel to meet clients, deals fall through, and revenue plummets. It all started with one little violation. Bad data always leads to bad decisions.
Okay, let's bring this all together. Why have we spent all this time on just 2 basic rules? Because these aren't just obscure rules for accountants. They are fundamental principles for anyone who wants to succeed in business. This is your foundation for success.
You see, when it comes right down to it, business runs on trust. When you follow these rules, you're creating a clear, trustworthy financial picture. That clarity is what allows you to make smart decisions. And that trust is what convinces a bank to give you a loan or an investor to write you a check. Without it, you've got nothing. So, if you're going to walk away with anything today, let it be these 4 points. First, accounting is the language of business, so learn to speak it. Second, the monetary unit assumption is our stable ruler that lets us compare things over time. Third, the economic entity assumption is the firewall between personal and business finances. And fourth, and maybe most importantly, violating these rules creates bad data, which will inevitably lead to bad decisions.
So, we've talked about how to measure and what to measure. But there's another piece to this puzzle, isn't there? The question of when. When do you actually record a sale or an expense? That's the next fundamental rule we're going to have to master on this journey. So stick with it, because what you're learning here is truly the foundation for everything else to come.